Hello, good morning, good afternoon, good evening. Welcome wherever you're joining us from today. My name's Sundip Jadeja. I'm Technical Manager at CDSB, and thank you for joining the first part of two webinars on how to account for climate in financial reporting. First, to introduce our speakers today, we're joined by Ravi Abeywardana, Technical Director at CDSB, an accountant by training who has held management positions within the finance and sustainability functions of a leading food and agribusiness. Simon Weaver, partner and co-head of climate risk and decarbonisation strategy at KPMG UK, previously an audit partner and has significant experience supporting a large variety of large listed companies. And Dr. Jane Jagd, a long-standing member of CDSB's technical working group with many years of corporate experience within both the finance and sustainability space. Firstly, some housekeeping. We have set aside plenty of time for questions at the end, so please do send those in throughout today's session using the Q&A function. Briefly to introduce the CDSB for those of you who aren't familiar with us. We were set up in 2007 at the World Economic Forum to advance the integration of climate-related information into the annual report, the mainstream report, for the benefit of investors to aid in their capital allocation decisions, ultimately to support in the transition to a low-carbon future. And since then, we've expanded to also cover the reporting of environmental and natural capital matters as well. The bedrock of CDSB's work is the CDSB framework for reporting environmental and climate change information in the annual report, consisting of 7 guiding principles aligned with the IFRS conceptual framework and 12 reporting requirements. The CDSB framework was one of the starting points when it came to the development of the Task Force on Climate-Related Financial Disclosures, the TCFD recommendations, which were published in 2017. The TCFD recommendations have been a significant driver in narrative reporting of climate-related information by companies in recent years. That being said, there is still a long way to go on TCFD reporting. One particular area where a lot of thought and work is still required is the reporting of potential and actual financial impacts of climate-related matters. And this often leads to a question as to whether climate-related matters that are reported in the front half of the annual report, the management reporting, narrative reporting, is actually being reflected in numbers and accompanying notes in the back half, and by that I mean the financial reporting and financial statements. Now, there have been a number of significant developments when it comes to financial reporting and climate in recent years. In the past 2 years, both the IFRS Foundation and the International Accounting Standards Board, IASB, have published papers clarifying that where climate-related matters are considered material, these should be reflected appropriately in financial statements. A key point in the IASB paper from November 2019 is when determining whether climate-related matters may be material, judgment is required on the magnitude or nature or combination of both. In other words, even if climate-related matters may not have a material impact on a company's financial numbers, based on its size, disclosure may be required due to its very nature. The IASB paper goes on to explain that in the context of climate-related matters, investors may expect disclosure in the financial statements, regardless of numerical impact, in which case such matters should be considered material. Now, significantly, investors have come out supporting this position publicly. In September last year, some of the largest investor groups in the world, representing over $103 trillion in assets under management, published a letter confirming that they do indeed consider climate-related risks to be material factors, and so companies should be reflecting this appropriately in financial reporting. Equally, this is very much on the radar of the audit profession. The International Auditing and Assurance Standards Board, the IAASB, published a note clarifying last year how existing international standards in auditing require consideration and assessment of climate-related risks. At the start of this year, the 6 largest audit firms announced they would be engaging with companies to encourage greater transparency in the impact of climate-related matters on companies' financial statements, and perhaps we can hear Simon's views on this later on. And to finally add, this is something that we expect that the regulators will be focusing on in coming years, something we've already seen in the UK with the Financial Reporting Council. So, where does a CDSB fit in? Well, last year, with the support of our Climate Accounting Standards Group, we developed practical guidance to support preparers in integrating climate-related matters into the financial statements, as this is an area that companies are struggling with. For example, earlier this month, a report by Client Earth found that of the 250 largest companies listed on the London Stock Exchange, only 4% made a clear reference to climate-related factors in their financial accounts. To be clear, the CDSB guidance does not look to create new accounting standards in relation to climate-related matters, but builds on the papers by the IFRS Foundation and IASB on how climate-related matters should be integrated into financial reporting based on current IFRS standards. Now, the first part of the guidance explores why climate-related matters are relevant to financial reporting, expanding on what I summarized earlier with regards to the IASB, investor positions, and so on. This was actually covered in webinars we held in November last year, titled Accounting for Climate, where we were joined by the authors of the IASB paper, Nick Anderson, as well as hearing directly from investors on the need for climate to be reflected in financial reporting. So I direct you to have a look at those sessions for more on that. Today's session is the first of two, where we will be exploring the key considerations under two key accounting standards when it comes to climate, as well as practical considerations as to how companies can begin to implement this. So you've heard plenty from me, so let me start by passing you over to Ravi, who'll be covering the matters that companies should be keeping in mind when it comes to IAS 1.
Thank you ever so much, Sundip. So I am the Technical Director at CDSB. And prior to CDSB, I was in industry. And the question that I often got whilst in industry was, how can accountants account for climate change using existing IFRSs? It can be done. We've demonstrated that. And I'm going to take you through one of those standards now, so IAS 1. And I hope by the end of it, you'll have a good understanding of how climate can be represented within this standard, and also be cognizant of the fact that it underpins other standards, such as what Simon Weaver is going to discuss in a moment concerning provisions. So IAS 1 allows a company to detail the sources of estimation uncertainty on climate change, on climate-related matters. Climate change isn't inherently uncertain. It is challenging to quantify and manage climate-related risks, and therefore how such risks might be reported. Challenging as it may be, companies can no longer avoid considering, quantifying and reporting on material-related matters within their financial statements. To really consolidate this, I'm going to give you an example of a use case of IAS 1 with respect to an impairment for a crude oil and natural gas company, in this case, Company A. So Company A has made a strategic decision to become a net zero by 2050, moving from oil to renewable energy. Subsequently, revised its 5-year strategic plan to enter the renewable energy sector. This is a clear indication of an impairment test. And IAS 1 would allow the company to explain to its investors assumptions used for the impairment test on current assets, such as projected declines in the oil and gas sector and increases in carbon prices, which led to some of these assumptions. This really simple example clearly illustrates that additional disclosures that companies could provide due to the uncertainty of assumptions that when used around climate accounting. And disclosing such estimation uncertainty is no different from what we're already doing when it comes to reporting on fair value assumptions or provisions. Another element to IAS 1 is that it provides a catch-all for all disclosure of additional information, which may not be required under any individual international financial reporting standards, but would be expected by users because it's deemed material. So to really consolidate this once again, I'm going to provide you with another example. So a global coal company, Company B in this case, has seen commitments to reduce its use of coal, in part driven by government policy to reduce the use of the phase out of coal and also to reduce its CO2 impact. Under such circumstances, this is another impairment indicator on the recoverable amount of assets held on the book. Impairment test indicates that despite demand falling in certain regions, demand for coal continues in other regions with lower regulation, and that the recoverable amount is far greater than the carrying amount, so no impairment is recognised. The beauty of IAS1 is that management has the capacity to actually provide information about these impairment indicators, even though there isn't a requirement to actually adjust the figures from the impairment test. And this is really important because ultimately, excluding this information would be considered a material omission from investors. IAS1 also addresses going concern considerations too. For non-accountants here, going concern is a statement that describes to investors whether the company can continue operating without the significant threat of liquidation over the next 12 to 18 months, and therefore remain in business for the foreseeable future. Climate-related risk can lead to going concern issues. And as our document, which was released late last year, had indicated, it was a significant driver of a bankruptcy of a major company over in the US in relation to the California wildfires. For many companies, at least in the short term, the impact of climate-related risks will not be significant enough to actually cause a material impact on the going concern assumption in the short term. But it is very important, especially for those operating in carbon-intensive industries or those businesses exposed to significantly physical climate risks. Finally, IAS1 also provides for the disaggregation of line items on the face of the financial statements. So in a situation where a company may be transitioning from carbon-intensive activities to be more Paris-aligned, investors may be particularly interested in the disaggregation of profit and loss and financial position items by business as usual, brown or low carbon, green activities or products, increasing the visibility between these two different line items. So in summary, I hope you agree that IAS1 is a good standard for the disclosure of climate change. If you have any questions, please do raise them and we'll get to those in the Q&A. But thank you ever so much, and I'm handing back over to Sundip. Thanks.
Wonderful. Thank you, Ravi. IAS1 and the methods you discussed are really fundamental to all of this work. And as we'll see next by Simon, and in the second of the webinars that we'll be holding, this underlines some of the other standards. So on that note, let me pass over to Simon, who will be looking at IAS 37.
Thank you, Sundip, and good morning, everybody. Great to be here this morning. Simon Weaver, I'm a partner at KPMG in the UK and co-head of our climate risk and decarbonisation strategy team. In that team, we're very much focused on helping clients understand their climate risks and climate opportunities, and also helping them on their decarbonisation journeys and helping them meet those net zero targets that so many organisations have set. The TCFD, which Sundip mentioned earlier, is often the starting point of those conversations. But I think one of the biggest changes we've seen in the last 3 to 6 months is a focus on quantification. And ultimately, that leads to a conversation around what does this mean for our financial accounting? As Sundip mentioned, my background is as an audit partner. So bringing both that audit and accounting and climate risk experience, it was great to be part of this working group and have the opportunity to work on the paper that was produced, and really great to be with you all this morning. So I'm going to talk about IAS 37. And before we go into the climate change specifics, I thought it's worth just a very quick reminder of the key criteria of IAS 37. So firstly, you need a present obligation, and that obligation can be a legal obligation or a constructive one, and it has to have happened as a result of a past event. Secondly, you need a probable outflow of economic resources to settle that obligation. And the final criteria is that you can estimate that reliably in terms of what that outflow would be. Now, in terms of climate change, I think that we just wanted to highlight sort of 3 areas where I think it's most likely that you'll grab your technical accounting book and look at what IAS 37 is saying. And those are firstly environmental provisions. Secondly, and where I'll spend most of the time this morning, is on the net zero or other climate related targets. And then thirdly, looking at onerous contracts and how contracts could become onerous as a result of climate change and the decisions you're making as a business around that. So firstly, in terms of environmental provisions, hopefully it's not new for anyone thinking about environmental provisions, but I thought it's worth taking a minute just to talk about it because it's a great example of a constructive obligation. And in the current environment, many companies are starting to increase their environmental promises. And as a result, it's important either as preparers of accounts or as auditors to be thinking about how might this impact the accounts. Make sure you're asking the right questions of your legal teams, of your operational teams, because ultimately those new policies that so many companies are putting in place could lead to new constructive obligations. So it's one to have on the key to-do list. So that's environmental provisions. Secondly, talking about net zero and other targets. And I think for me, this was probably the one where we debated the most at the working group level in terms of IAS 37 and in some ways wasn't the most intuitive example for me when I was first thinking about this. My initial thought when I thought about net zero targets, so let's say a company has set a net zero target for 2030, was to think that there's a constructive obligation there because that announcement has been made. For most organizations, getting to net zero will have some kind of economic outflow, either as a result of carbon offsets or otherwise. And because of the carbon offset market, there is a way of estimating reliably what that cost would be. But however, the sticking point that we got to was then thinking about actually, until you get to that year, so 2030 in this example, the company still has a number of choices of delivering on that promise that they've made to the market. So for example, if those net zero commitments were very focused on scope 1 and scope 2, for a lot of organizations, it's absolutely possible that they could remove those carbon emissions and achieve that without an economic outflow. Now, from a technical perspective, it's paragraph 19 in IAS 37 that talks about obligations that are not independent of a company's actions should not be recognized as a provision. And actually, when you take a step back, it makes complete sense because otherwise strategic options and strategic decisions that companies are often making would start to lead to potential provisions, and that just doesn't make sense. Now, in terms of the guidance that we've set out and Sundip talked about, example E is where we talk about this in more detail. So if you want to go for more detail, example E is where to focus. But there's a couple of other points I just wanted to make, and this is noted in the example. But Sundip talked about the importance of consistency between the front half and the back half of annual reports. And there's probably not many annual reports this year that don't talk about some kind of decarbonisation target in the front half. And therefore, even though you haven't got a provision, I think it's right that companies should start thinking about what kind of commitments do they want to talk about in the back half when it comes to net zero targets. And the final thing to say is one of the big things we see from investors and wider stakeholders at the moment is actually asking companies to come up with more interim targets. So even though they've set a 2030 target, what are you going to do each year? And as that starts to come into fruition, clearly more provisions might make their way onto the balance sheets of organisations as they aim for those interim targets in each year. So I think just to conclude on this one and back to what Ravi was talking about in IS1, it's all around how do you determine the right level of disclosures to give the users of the financial statements the info they need. And I think in terms of provisions or IAS 37 and net zero, that's more likely to be around a commitments note than a provision, at least until you make those interim targets.
Sorry, Simon. Sorry to interject. We've actually had a few specific questions around decommissioning provisions. So is there anything you can actually add to that or can say around that?
Yeah, that's a really good point. And I think there was, if I remember rightly, it's example F where we talk about that in the report as well. And I think probably two things to kind of highlight out of that example and the guidance we've got. Firstly is a lot of organisations already have decommissioning provisions. And I think what's important around climate change is to think about how that might change the assumptions you've got within that decommissioning calculation. The most obvious example being the time until that decommissioning will have to occur. So what we've seen on a number of clients, so take a mining client, for example, if you've got products that you're mining that actually under certain climate change scenarios will not be used as much in the economy, then there may be a need for that mine to close earlier, and therefore you'll be bringing that decommissioning provision calculation earlier in the time. But secondly, it's also thinking about possible new provisions as well. So one of the things, I think it's the example we've got in the document, is around pipelines. So a lot of organisations with pipelines, oil pipelines, for example, will have said, actually, we can't estimate when we'll have to decommission. So there isn't a provision in the book today. But again, thinking under certain scenarios, is there a requirement of that? And it's important as an organisation to think, are there any new decommissioning provisions as a result of those scenarios that we're looking at from a TCFD perspective? And I think the final thing I'd say is if you have got changes in those decommissioning, then it's a good chance that you have to look at your triggers for impairment. And obviously that will be discussed in more detail on the second webinar. So just coming back to the final point of the three areas, which is onerous contracts. And I think similar to environmental provisions, this is all about asking the right questions to the wider business, whether that's the commercial team, the risk team, or the strategy team. And one of the key things here is coming back to TCFD and thinking about that scenario analysis that's recommended by the TCFD. Firstly, by doing that scenario analysis, it gives you the best opportunity to make the most effective commercial decisions. But secondly, it will highlight where there are risks within your operations and your commercial construct that could result in those onerous contracts. And I think finally, similarly to environmental provisions, it's important to consider any climate change related statements and commitments that have been made that could give rise to an onerous provision. And for example, G, it is in the guidance, we talk about the pledge to remove plastic from a supply chain by 2025 and what that could mean from an onerous contract provision perspective. So very quickly to conclude, 2 points really. Firstly, you need to consider how climate change impacts those current IS 37 estimates and judgments, such as decommissioning, as mentioned by Sundip. But secondly, it's important to link in with your wider teams, the risk sustainability strategy teams that are working on those TCFD scenario analysis to really understand the potential broader impacts on your IS 37 accounting estimates and judgments. Back to you, Sundip.
Wonderful. Thank you, Simon. So it's clear that when it comes to these matters that you discuss on IS 37, it will become increasingly important for companies, especially when they start increasingly setting targets, commitments, etc. So something that really should be considered now and going forward. Now, we've heard some of the key considerations that companies should be thinking about when it comes to IS1, IS 37, and climate. I'd like to pass it over to Jane, who's going to be looking at how companies can begin to better implement integration, practically speaking. So in real life, what can companies be doing, or what should companies be thinking about?
Thank you, Sundip. I would like to bring you today 3 very practical tips on how to get on with this. And the first one is to bring key employees together. Then how you actually are going to approach this. So you have to define the model for that. And there are a few I can briefly tell you about. And then, of course, you should also define upfront what is really a risk and what is the timing we're talking about, what is important for you and your company. So the first one and the most important one is to bring key employees together. And I do know this sounds very banal, but it is really not. We can see it right now that we see a range of companies who are issuing TCFD reports. And that was not the intention, I can tell you that, because the FD in TCFD is financial disclosure. So that is not the intention. When we see TCFD reports, we're like, something went wrong. And usually it's because it is the sustainability or communication departments who have made this in silos. And that was not very helpful. So these TCFD reports are probably a good start, but you will have to lift it up and bring more people together. What we do know is that the people who have to talk to each other are very different. So it will most likely take some time to be able to have a common language. So do spend some time on this. You should not do this in December when you are to make your report in January. That is way too late. So start now if you can. Then also really acknowledge your roles. And it's important, because we're talking about financial disclosure, then realize that the most important persons here are the financial people. They have the keys to the bus, as I write here. So if they don't want to drive, the bus is not going anywhere. So if we make this too flimsy, or it is simply not specific enough for the financial people to actually make quantified assessments of this, then it's really not helpful. So be aware that this should be really specific so that we can act on it and we can make some quantification. So once you have people together, then these people should, of course, also define, okay, how are we going to approach this? And currently we see at least 2 different TCFD models, and thereby also the ability to include climate on your financial disclosure. And one is the factor-by-factor model, and this is where you stress test your financials given one value factor is changed at a time. I will tell you more about this in a moment. And then there is the holistic scenario approach, which is it's a much deeper process where you change things in scenarios with many factors changed in one go. But let's look into the factor-by-factor model. The factor-by-factor model is by far the easiest to perform, and it's also by far the easiest to convey, both to financial people, because this is very much down their alley. They already do stuff like this with regards to IFRS 7 and 9, so they will understand the methodology here. This is also easier for the investors. We have talked to investors who indicate that if the factors that are changed are the same across the peers, then they can actually use this in their analysis of how resilient is these companies individually, and also aggregate it to portfolio analysis. So this is quite important to understand. What is also important to understand is that the factor-by-factor model could be a stepping stone. So you start here, you do this, and once you are comfortable doing this, then you can move on and then work with the bigger holistic approach. So if you look into a holistic approach, then it will be a far deeper process. Likelihood is that you will have to bring in also external experts, because this is really difficult to also know what are the impacts, for instance, on macroeconomics and stuff like that. Likelihood is also that some of the scenarios that the input we get from IPCC or IEA is not specific enough. And therefore, we often see that companies who are working with this, they use external experts to be more specific in the areas where the company is active and having activities going on, or where they foresee that the impact will be, and then they need to know how bad or how worse will be in the future, and what is the timing here. It's a much deeper process, and therefore it is also more robust. We should also acknowledge, though, that this could drive the discussion a bit off stride, because the assumptions may not have the same likelihoods. So it is important when you do the scenario approach that you are aware of what is the likelihood of this or that. But the most important part here is also that you bring people together and you have the discussions about what is the impact here on this cash generating unit. Also, even before you do one or the other, then you have to define how you measure risk. And you have to be very specific, and it has to be financial, and you have to define when is it important for the company, what is the materiality level. And you also need to define the time horizons. We sometimes see that the time horizons are fairly short. And for many companies, it would potentially be more reasonable to look into having time horizons which are aligned with their asset lifetimes or their product lifetimes. So this is some things that you need to discuss up front. What time is it actually we're talking about? What kind of cash provision will we look into if we're talking about 10 years, 20 years, 30 years, if that is needed? It depends very much on what kind of company you are in. And it's also important to put in your external report to the investors what the impact is and what time horizon you're looking at. And the reason for this is that many investors, they would like to know whether they have a skewed portfolio, whether the risk profile are the same for all the companies in their portfolio. So for that reason, even if you consider that the climate does not have any impact on us right now, then you should include that information in your report, because aggregated for the investor, it might have a point for them.
Thank you very much, Jane. Some really practical suggestions as to how companies can begin or improve integrating climate-related matters into their reporting. So now we'll move on to some questions from the audience. We've had many come through, but please do keep sending those in. Firstly, if I begin by asking Ravi, from your time at your previous organization, where I understand you transitioned from the finance to sustainability function, do you have any other suggestions as to how organizations can effectively integrate climate into financial reporting?
Yeah, of course. Thanks ever so much, Sundip. So really building upon what Simon had mentioned earlier on, it really is asking the right questions with particular departments. No one individual or one department really has all of the answers to all of these tricky questions which and challenges which modern companies are now faced with. And in my time in the sustainability department, it was often the case of how to create those necessary connections with the risk department when it comes to TCFD disclosures, or finance department on wider accounting matters, the department which I was previously part of. And it's very much a journey. There's no quick solution to this, and it really sometimes is changing hearts and minds in all of these sort of matters, and working with those different departments to make something more tangible out of these quite around these quite big statements which are often quite high. So it's really bringing it back into the normal day-to-day operations of a company. So just to reiterate, it really is asking the right questions of different departments and really building those different relationships internally, and building out on the different experts in those different departments to really address the questions which companies have.
Thank you, Ravi. Simon, one for you. So how is the audit profession approaching this question of climate and financial reporting? And if you can kind of comment on how KPMG might be looking at this in particular.
Yeah, no, definitely. And I think probably like the rest of the market, we're definitely on a learning curve as an audit profession in terms of climate change. In terms of how we're dealing with it at KPMG, we've got our team, the Climate Risk and Decarbonisation Strategy team, are very much supporting our audit teams as specialists this year. So we're doing consultations as a result of material risks or climate risks coming up. But we're also got a lot of training for the wider audit practice, recognising, this is a financial risk, and therefore it needs to be embedded all the way from the risk assessment and planning procedures of each audit. I think one of the challenges for the audit profession as a whole, but the broader market as well, and I mentioned this to a couple of investors at the IIGCC, is as we are moving so quickly in this area, in terms of resources, either tools or human resources as well in the market, there's a real lack of them and therefore the training is crucial. But in the meantime, we need to recognize some of the limitations around that quantification and valuation challenge that absolutely is there in terms of climate change. So as a result, I think in the accounting and therefore on the audit side, the real focus this year is around making sure we've got the right disclosures in the financial statements and highlighting where these risks are, trying to improve on that statistic of 4% that you mentioned in the introduction, Sundip. And I think then as we go through 2021 and beyond, then the focus is going to turn much more in terms of the valuation side of things. And that will be enhanced as more companies start to quantify through the TCFD scenario analysis. So I think we'll see big changes in this area for a number of years, but definitely we're on our way in terms of the learning curve from an audit profession.
Brilliant. Thanks, Simon. And Jane, one for you. So ultimately, if we are trying to bring climate-related matters into financial reporting, we're talking about quantification. So practically speaking, where do you even begin in quantifying these matters?
Well, I would start by looking into your forecast models and try to include that you also need to consider climate impact, and it have to be also in the cash flow, so that you are really sure that you are considering this. For instance, as Simon said earlier, also when you look into your impairments of your assets. So really look into having it included into your models, your calculation models in the financial area.
Brilliant. And then there's a question around kind of IAS1, which wasn't actually covered earlier, and around going concern. So the reality is, it's unlikely that climate change is like to have such effects on any one company that it would impact going concern. So question for all, so what should companies actually be thinking about when it comes to kind of that space?
Do you want me to go first?
Please, yeah.
I think there's a risk that we start sounding like a broken record with these questions, but I think it has to start with that scenario analysis, because the challenge with going concern, I totally agree with the statement, is it's obviously a very short-term view. And Mark Carney's point and Michael Bloomberg, when they first came up with the TCFD, was about stretching organizations' planning horizons. And stretching those planning horizons took beyond the normal 3 to 5 years that we need to take climate change into account. So I think starting with those scenarios is crucial, as Jane talked about. And then it's starting to quantify. And once you've got that, you can start to think what that will mean for your financial statements. So I think it's unrealistic that going concern will be an impact for hardly any companies in terms of climate change in the short term. I think in terms of that longer term viability, and if we think of some of the challenges coming from the Bryden review around resilience statements, then in the UK, that will absolutely start to come into those resilience statements when we're looking at climate change.
Yeah, and I just want to build upon that. I think it also addresses a slight gap in current financial reporting as well, which is often quite short term in its horizon. So TCFD and the actual scenario analysis, which accompanies that, really does help companies to start thinking around those sorts of concepts of business resilience going beyond the 12 to 18 month time horizon, which going concern statements often really focus upon. And this ultimately is extremely important for for investors, especially long-term investors. What is the potential risks associated and opportunities associated with a particular investment, if they had an investment in mind?
Thank you. So we've got a question here. We've talked about targets, etc., but do companies need to be outlining the investment needed for meeting their targets, and to be providing kind of appropriate disclosure around kind of how they're actually going to meet their targets?
I think probably for me that I would expect it in the front half as part of that overall strategic response to the climate risks and opportunities that TCFD requires. Not necessarily quantifying, but I think investors will be expecting a view of how you're going to meet those targets. I think then in the back half, it wouldn't have to be included in any of the valuations in the balance sheet as we discussed in terms of IAS 37, but depending on the materiality and trying to get that consistency between the front half and the back half, it's thinking about, are there any commitments or otherwise that you would want to disclose either as a qualitative or quantitative measure in the back half?
Yeah, good comment there. I guess there's also a capitalization element around some of these investments if they're actually incurred as well. And I guess we'll touch upon the PPE section in our next webinar as well. But yeah, reiterating what Simon had mentioned, it's very much ensuring that the front half narrative around the overall vision, which is vision and the actual investment which is required to change companies and put them on that green journey is flows through when those investments are actually incurred in the back half as well.
I've got a question a bit more TCFD related than kind of purely kind of affecting the financials, but I thought I'd ask it anyway because it's a good question. Do you think there is a fear in companies to publish their TCFD scenario analysis results due to potentially causing shareholder panic, etc., or giving information away potentially to peers?
Yes, I know for sure. There are many companies which are very hesitant is probably the right word to show their scenarios, and especially we also see, especially on the opportunity side, we see some who are hesitant, especially due to fear of litigation, and that is fair and square. But at least the risk part that is needed, no matter whether they are considered to be a bit insecure about whether this is right or not. That is exactly the point, because otherwise, if it was certain, then we should not talk about provisions, should we? So that is the case. But surely companies are hesitant showing this.
And Simon, something related to that, could you actually elaborate on how assurance procedures will be made possible for TCFD, and particularly around kind of the outcomes of scenario analysis? Because I assume that's a challenge for both parties, both the preparers and the assurers.
Yes, a lovely question. I think it's hard. I think as we're at today, and in terms of the guidance that's out there for the scenario analysis at the moment, it's not that prescriptive, and there therefore isn't a kind of standard that you could provide assurance against. So as a result, at the moment, the kind of level of assurance that we could do is more looking at the robustness of the processes and the modelling, and it's what we call little a assurance. So it does give the company a level of assurance, but it doesn't give that assurance that we'd be able to write, you have performed in line with a regulation. Because although TCFD has some recommendations and guidance, it's not as prescriptive as allowing you to do that overall assurance. Now, I think back to Jane's point around the question around fear, one of the things we hear constantly is around the worries around the consistency of what people are going to report, especially when it gets to quantification. And I think over the next couple of years, it's thinking about, well, are there ways of making that scenario analysis more consistent and maybe more prescriptive? And as a result, you may be able to get to that big A assurance. But I think that's one to watch for.
Yeah, very good comments there. Consistency, comparability. It's ultimately very important when such disclosures are made, and especially when it comes around the TCFD quantification numbers. What is the actual material impact of climate change on a potential company? It could it could really there's a potential that it could upset upsets shareholders. Or so I think it's very important for very strong narrative to follow the TCFD disclosures and really take shareholders on that journey of what it really means, because there's often a story to be said around a number. There are different trajectories which are being played out, different scenarios, different data sets, which may not be consistent with other companies within the same sector. And I think it's also important to note that there are concerns around disclosing such information in the markets. And the reason why certain jurisdictions are looking to actually mandate this as well. So you've got the likes of New Zealand with their really progressive policy around making this mandatory by 2023. Here over in the UK, mandatory between 2023 and 2025. And then also over in Canada as well. So there seems to be movement, a real snowball effect around this, and it's a good sign, to be honest. So, yeah, comforted to see.
Thank you. So it's a question that potentially falls outside of our scope of expertise, but I'll try it anyway. We've got a question saying, our participant would be interested in hearing thoughts of our panelists on how we think public sector organizations are faring in terms of reporting on climate-related matters compared to the private sector. So I don't know if you have any thoughts on that.
Yeah, we have looked into it. At least when I was in IFRAC, we also looked into, can we see any differences? And it is quite clear that those who are the companies which are listed, they are the most prone to show of this, probably because they are in some way obliged to. But we also see that many also fairly large companies which are not listed, they now ramp up, but it goes slower, I would say. And then we have also companies which are publicly owned by communities and stuff. I have yet to see it, I must say. I haven't seen it at all.
And the one thing I'd add with some public sector companies, there's an obligation to disclose as soon as they've got information. And I think that's one of the challenges around TCFD. We've kind of talked around doing that scenario analysis, quantifying, but then it's a decision of what you disclose. And I think the added fear for some of those public sector companies is once they've done that, they do then have to disclose it. So that's one of the other dimensions for them to be considering.
Thank you. A question for you, Simon, coming back to kind of what you presented earlier around commitments. Would you expect all companies with a stated net zero target to have some sort of narrative in the commitments note or equivalent in the back half?
I think it comes down to materiality of what that means for the organisation overall. I think back to the consistency point, just because of how much is often made around net zero statements, I think it's quite a good idea. It's not a requirement. I think the other challenge we have, and I think there was a question that came up on the chat as well, was around how do you ensure consistency of different net zero targets? So lots of people are saying they're going to be net zero, but actually what's the definition of that? And I think that's one of the other challenges we need to think about. And there's obviously there's a science-based target initiative consultation out at the moment to try and improve that consistency and some of the technical details around it. And I think that's one of the things we need to make sure that it's not mandatory that people are talking about commitments, because it could be hard to compare those consistently. But I think it's quite a good direction of travel on that overall consistency between front and back half reporting.
And on that, Simon, in relation to the question you noticed, is there something to be done by kind of sector groups or equivalent in developing more standardized models, be it around transition pathways, be it around key assumptions that we use, etc.? And that's a question, I guess, for all of our speakers.
Yeah, I think there definitely is. I think in the UK this year, as we move to the mandation of TCFD, as Ravi mentioned, I think that's an ask we've had from a number of companies is starting to convene sector groups to drive some consistency. And I think that would be a really positive move forward to then enable more transparent disclosures going forward.
Brilliant. So we're coming to the end of our time. We've got one final question, actually. I'm going to start by directing to Ravi. So the focus by IASB, IFRS Foundation, the CDSB itself, and this guidance has been on climate. But what about other pressing environmental or social matters? Can and should these matters start to be integrated into financial reporting as well?
Absolutely. And if we go back to the original document, which was released by ISB and Nick Anderson's work, IFRS is not only conducive to climate-related matters, but also other risk matters as well. And what do those risk matters look like? They go beyond climate, so they also address water-related financial risks as well. So certain beverage companies are at risk of water scarcity within their supply chain. What does that look like from a financial perspective? Are there any potential impairment tests which are required because of these sort of wider environmental impacts? And this is related to another piece of work which CDSB is currently on with, to do with water-related financial disclosures. We currently have a consultation out at the moment on this specific work. And later on this year, we also are starting off on biodiversity. So what do biodiversity risks look like from a financial perspective? So there's a huge decline in bee populations across the world. And bees are very important in pollination. They provide those services to lots of agricultural companies. So there's a genuine concern at the financial ramifications of declines in biodiversity on a company, and these sort of matters ultimately wind back down to how accountants should be considering these wider sustainability issues, which are often parked in the sustainability department, but genuinely quite material for a company. And wider still, talking about social issues. So the recent issues to do with the garment industry, Boohoo, for example, or the Ram Plaza fire over in Bangladesh. These are social safety issues to do within a supply chain can quickly, if it goes wrong, can quickly have a very bad impact on a company's performance from a reputational perspective. So these are all things which companies are really up against. It's a really and these are things which do need to be considered, but there are lots of strains on companies at the moment. So I think it just needs to be really thought through. A roadmap really needs to be thought through with regards to the different challenges and how these sort of approaches are addressed.
Yeah, I'd agree with that, Ravi. I think the point around a roadmap and kind of taking it step by step is really important, because just the TCFD question and starting to think about climate change in the financial statements is a huge transformation for most organizations in terms of the way they're looking at risk and opportunity. But the positive is actually what we're finding is clients are going through TCFD and really driving the strategic intent through those scenario analysis. It can be a real catalyst of change of how they're looking at risk management more broadly. And I think ultimately, as a result, once you do that, naturally these broader impacts will start to come in, which will be very good for all.
I can second that, Simon. The trouble or the challenge with the social area is that it is not as well developed as the environmental area. We can see it just simple stuff like just counting how many employees do you have. It is done in as many ways as there are companies. And you can say that has nothing to do with the impact on the financial. Well, it matters if you need to know how many engineers do we have, what are the demographics for engineers, and you're needing of engineers. Then you need to know, and that is a problem. But currently, we are not in a situation where we are able to measure these things in a good and comparable way across. So we need to start by being good at that, and then we can move on to actually include it in the financial considerations also.
Brilliant, thank you all. And with that, we'll wrap up the questions. So to finish off, the link for the accounting for climate guidance is coming on screen now, and it has been shared in the chat function as well. This is actually an area that we're continuing to focus on here at the CDSB. So please do send us in your thoughts, comments, feedback on this area of work, because we'd like to take that on and kind of support preparers as this area develops. Secondly, please do register for part 2 of the webinar, which will be held on 11th March at 2:30 p.m. UK time, GMT, where we'll be looking at IAS 36 and IAS 16. And thank you now very much to our speakers today, Ravi, Simon, and Jane. And finally, thank you all very much to those who have joined us today. Thank you for joining, and goodbye.